Well, Alex Kjorven from Ourboro, welcome to the show.
Thank you. It's a pleasure to be here.
We're so happy to have you on. So Ourboro, actually, I contacted you guys, your company, out of genuine need, for a client to be able to help them out, looking for like an alternative solution to selling some development properties and some new construction stuff. And but at the same time, it was like, okay, we're in a market, we're in Toronto, we've got
It's really hard to take TK perks seriously
yeah, okay,
because you've got Zoom
all right,
shit.
all right. I'll make it much easier to take me seriously.
Yeah.
Oh, what's going on out there?
Oh my God. Okay,
You
good.
must be feeling great. I don't know if we're talking about it yet. I don't know if this is like something we're going to be going into later on, but you're feeling pretty good today. You look good. Your skin looks good.
Does my
Everything.
skin look better from this?
Yeah, flush. No stress.
I feel
Cortisol
good.
levels are down.
Stress levels are gone.
Yeah.
All stress levels are gone.
Mm-hmm.
Money is out of the market.
Mm-hmm.
I can breathe a sigh of relief.
Mm-hmm.
It was hairy. It got a
Yeah.
little hairy.
Yeah.
You know that. Yeah.
These are big deals and they're not easy to do. And
They're not easy to finish.
I don't know
God,
too many. I don't know any other person as well as I know you who could get the deal done.
that was
So,
thank you. That was
yeah, I think
I come across as a goof, but there's a lot going on here.
there's a lot going on there. People
There's a
don't
lot
understand.
going
We're going to
on
do an
inside
episode on it and they're going to see the inner workings of Darryl
inside
Frankfurt.
my brain. Uh-oh.
Ooh, get some popcorn.
And a seatbelt. All
Yeah.
right. Well, listen, I got to tell you though, I feel a little disconnected from, the residential market right now. And it's funny. I'll give a little shout out to Mr. Tom Story because in his latest video, he said, it, and we've talked about it too, but like it must be super hard for people to know what the hell's going on. I mean, every headline is like inflation is down, and one guy will grab onto that and go, wow, everything's great. Here we go. Get ready. Hang on. And one guy will go, oh, yeah, well, you know why it's down? Like, it's not really down. It's like, right. It's
Do
like,
you know who
it's
wrote
only,
that article?
it's like who,
Yeah.
right? But it's like, it's tough to navigate. It was tough to navigate before.
Yeah.
Right. And
It's never been easy to navigate the real estate market.
nobody
There's
knows.
never been a time ever where everyone was just like, do this and it's going to work out for you, guaranteed. That's why our saying here at the Canadian Real Estate Show is the only guaranteed way to make money in real estate is to sell things to other realtors.
Is to sell things to other realtors. And it's
Yes.
true.
Yeah.
I've realized
Those guys, they'll buy anything.
those
But
guys will buy anything.
as far as making money in real,
They
you
need
take
help.
chances. There's risk, and it's not as straightforward as you think.
There are a lot of great stories that will come out of that now that it is finalized and finished. That will
Yeah.
be
get into it.
entertaining and educational. That's for damn sure. But I'm
Nice.
glad it's over.
Do we have a guest today?
We have a guest today.
Yeah.
And I don't know if I'm like I don't want to talk about the same shit again.
Mm.
Do you want to talk about if there's going to be a recession or what's going on with inflation or the bank
Well, we
rates
haven't
or-
been able to figure it out yet. And so
Oh.
far, nobody we've ever talked to seems to have a clue what they're talking about either. They've got great guesses and they've got a lot of facts and they're very smart people and I respect them. But at the end of the day, we all know that the future is unknown.
Unknown. It's unnerving though when you go, to things that you trust or think that you should be able to trust, and on one day it sounds really bad, and on the next day it sounds hopeful, and then on it's like, don't you feel like you're just getting smashed around like in those cartoons where they used to throw guys around like it was nothing?
Try being an agent.
Oh my God, yeah.
Right? Yeah. Your clients are telling you how much more they know than you, and they heard it here, and they know
Sure.
what to do, and they've done this before 30 years ago, and it worked then, so it should work now, and that's the way it is. That's what we signed up for. I think guys like me and guys like you for your job are just built for this, and there's people who aren't built for this.
Yes.
And
Yeah.
unfortunately, that's true because I wish it were
It's
different.
it is true. We talked
Yeah.
about it the other day, like on the
Yeah.
phone. Like people are just, you got to be wired differently to do some of this stuff because it's pretty stupid, a lot of it. And it's
Yeah.
pretty, it can get pretty intense.
It can get intense.
I mean, I
There can
guess
be
if
a
you
lot of
have
stuff
like,
going on.
even if you got billions of dollars out there and you got billions in the bank, like in times like this, I mean, it can't be, you know, I guess if you're Bezos, you're sitting on your yacht going, who gives a shit? I just lost 40
Shares
billion.
are down.
Yeah,
Woo!
whatever. Hey,
Yeah,
you guys
it's not
paid for this
not as
yacht.
impactful.
It doesn't
No, we've
matter.
talked about that. The guys, the lenders right now, speaking to a mutual friend of ours, lenders right now are nervous. Their loan to values are coming down. These are private lender guys, right? They're taking on less risk. They are, being more, they're scrutinizing. They're not looking at
Sure.
certain properties. Like talking to one guy, he said the
They're-
only reason we'll look at this is because I'm involved in that. We have a relationship, and so that they know at least certain things will be handled well. But it's like otherwise we wouldn't even look at this file.
Well, and I was thinking about that today while I was walking the dog, and I was like, you know what? Like, I wonder if I'm buying something, like, what can I actually afford now? Because the amount of money I used previously is not going to get, it's like the same as a house. It's like, it's not going to get me as far as it got me on the last one.
Mhm.
Right. Like now I'm going to have to like look at a smaller, crappier deal so that I can actually get something financed. Because if I tie something up, maybe I
Yeah.
can't get financing for it. And if
Yeah,
things are
exactly.
still falling, like who knows what's going to be, right?
Yeah. Yeah.
I don't know how people make decisions, but I think our guest today, which we can, you want to
Jump in.
you want to guess how to say his last name?
Alex, it's the girl.
Her last name?
We can edit that part out.
Boom.
No, I don't, because we did this last time and I
It's-
wasn't very good at it.
I think you're bad. Didn't you say you won?
I think we both lost. I think we both lost. I beat you.
Generally, you beat me.
I beat you. Yeah.
I don't even want to guess.
I'm sure like your first.
Jorgen.
No, I think your first
Jorgen?
guess would be like close. I don't think you'd be that far off.
I think the K is silent. That's my guess.
I'm sure you'll have very like good guesses at the end of the day.
Hi, gentlemen.
Hi, Alex.
Hello.
Did
Welcome,
I hear
welcome.
someone say that the K is silent? That's the best interpretation of my name that I've heard so far.
That
But
was
see,
my.
I told him he would get it though. Like that's his intuition,
Well,
right?
We
Was
just finished talking about my superior intellect from my French immersion upbringing. So, I mean, it was pretty
good.
obvious
Good
to
little
me.
segue. Yeah. So how do you pronounce your last name, Alex?
It's Kjorven. It's the J that's silent. Very
Oh, oh no, Darryl. You know what? He's really confident when he says things, so I kind of believe him. But yeah, definitely, that's Kjorven. I knew it all along.
Listen, guys, it was just a quick tech check.
Yeah.
My AirPods died just this morning, but I did this. I am in like what do you call them? Like safe rooms. I'm not in a
Yeah.
safe room, but I'm in what feels like one in my basement. 'Cause
Awesome.
it's carpeted
If
and it's
everything's okay, blink with your left eye. Now I don't even know. Hold on.
I
The
went
reason we
into the
do-
most enclosed, carpeted, like walled space I could find to reduce echo. So I want to just do it like an audio check. Is it okay on your side?
Yes.
Sounds great. The reason for the earphones is generally because I can't stop cutting people off and we just need them to hear that. But if you're
You hear yourself better.
Yeah.
And so when you hear through the headphones, then you kind of have a better gauge of like when people are talking or not. It's going to be fine. Honestly, half the people don't wear headphones. You'll be fine. So
Okay,
it's just a
okay.
recommendation. That's all.
The ones I've done in the past have always been headphones. I know that's preferred, but I was like, sorry, is this recorded?
Swearing is
Swearing
permissive.
required, actually, before we
Yeah.
I cursed that I didn't charge them properly last night. And then I didn't know if the video was recorded. I didn't think so. I hadn't planned on it, but
Yep.
I have a face for radio. I said, like
You're doing fine. You're doing fine. Okay. No issues. We recorded on YouTube. We do the podcast through the other podcast platforms. So
Okay.
yeah. And your background is top notch.
Very
ideal.
Probably the best guest background we've had.
I think
Oh,
so.
really? I mean,
Like-
I can make I could make it like, whatever, a little bit more Zoom-esque, like, with
No,
No,
this is
no.
but this is,
That
I got
that's
on
like the
brand.
typical. No, you've done
That's
it and it's
better.
branded, and that's what
Right.
you're here all for. So this is great. All right.
Good. I
So
mean, I'll remove like the video filters and the.
Oh, that's even better. How do you
that's
do
way
that?
better. That's way better.
I
How
want
do I
that.
turn this off
Should we
now?
not? Should we do that today? Just choose
Yeah,
video
let's go.
filter.
How do I do this? Choose
Yeah.
choose
there you
video
go.
filter.
Yeah.
Yeah. This
Let's
is
at
what
least
it
start
would
it
be
like this. Okay.
if
Well,
we
at
were in
least
person.
good. Well, at least start it. Daryl, don't copy me. Come on.
Well, there's not too many options, man.
Fine. I'll choose
There's
another
tons
one.
Hold
of
on, no, I'll do it.
options.
I'll do it.
There's a lot of options.
Hold on, here we go. All right.
All right. This is fun. I like this.
It's better.
Oh, we picked the same one again. What the hell?
Okay.
This is horrible.
All right. All right.
Hold on. One more. Okay.
You got to do a countdown here.
Everybody thinks I'm
It's
shady.
like rock, paper, scissors, Zoom
Here we
filter.
go.
All right. Perfect. Well, Alex Kjorven from ourboro, welcome to the show.
Thank you. It's a pleasure to be here.
We're so happy to have you on. So ourboro, actually, I contacted you guys, your company, out of genuine need, for a client to be able to help them out, looking for like an alternative solution to selling some development properties, some new construction stuff, and but at the same time, it was like, okay, we're in a market, we're in Toronto,
It's
we've
just
got
really hard to take TK perks seriously.
Yeah, okay.
Because you've got Zoom.
All right.
shit.
All right, I'll make it much easier to take me seriously.
Darryl is losing it.
Oh man.
Here, how about
I'm sorry I introduced you guys to that feature.
uh,
There, now that I
Okay.
can see your eyes, it's totally better.
Oops.
oh, what'd you
Oh
do?
boy. Oh my goodness.
You messed up the
All
whole
right.
thing.
None
Oh, you bounced all
on.
our
This is gonna make
cameras
the
around.
off.
This
right.
is gonna make the cut for YouTube, guys.
We'll get it. We'll get
There
it.
we
We'll-
go.
they don't, some of this will make the cut. I can promise you.
We don't have
So-
to edit any of this.
So I contacted ourboro. I got some information, and I
Ugh.
was saying to myself, hey, what a neat idea for us to have someone from ourboro on the podcast, talk about what it is that they do, give us their insights on some of the needs that consumers have today, and I guess the solution that ourboro is providing. So welcome, Alex. Thanks for joining
Thank
us.
you.
Now tell us, like, how long has ourboro been around for? Because I'm actually hearing your ads now. We'll get to that, but like you guys are really like putting your name out there recently. So what's going on? How long you guys been around for?
Yeah, the origin story of ourboro actually it begins, over a decade ago. There's been there's a number of co-founders of ourboro, and the genesis of ourboro really started with many of us coming from the impact investing landscape. So big believers of using profit-seeking capital to create social outcomes, like positive social outcomes. And Norm Tazeski, one of the co-founders, and myself had worked together for a number of years prior to this, and a number of projects around affordable housing and using impact like social finance tools to create affordable housing. Norm met Nicholas Pope, the other co-founder, when they were working at a development firm together. And the two of them, had similar ideals and values. And then so the original idea for ourboro, as we know it today, started back in 2008. It was incorporated in 2019.
Whoa.
Right. But like I said, the genesis of the idea, the concept has been marinating for almost a decade prior to that. And it took various iterations, various forms through its journey. So we were properly incorporated in 2019. That's the inception of the company. We started building a team around this idea of raising a pool of funds from investors who would otherwise be landlords and would rather not be. So investors who would like to have a diversified portfolio in residential real estate, but don't want to manage that property themselves. But instead, that pool of funds can be used to co-invest alongside legitimate homeowners who don't have the down payment. So our down payment contribution would help them bridge that gap into home ownership. So it was a bit of like this merging of two worlds, a win-win for investors. They don't have to upkeep their property. They get engaged and involved homeowners who can take care of the property. And then both parties share in the appreciation when property prices increase. It truly is modeled after, co-owning, which has been around for a very long time, of two adults or two parties who are going to share a space together and live in that place, and therefore sharing the cost of maintenance, or not maintenance, but sharing the cost of upkeep and the mortgage. So ours is different. We refer to ourselves as professional ownership in the sense that we don't live in the property with you. you get to enjoy the property 100% on your own. Because of that, you also take care of the property. You're responsible for the maintenance, the upkeep, the mortgage payments, but we provide that initial upfront down payment contribution in exchange for a proportionate share of the future like increase in the value of the property, the future profit of that property.
You give the whole deposit, the whole down payment?
We give up to 75% of the total down payment that's required.
Up to 75%. And how do you secure that?
So we have a fund. We raise funds from a pool of accredited investors, high net worth individuals, family offices. So that pool of funds is what's used to provide that down payment contribution.
But how do you secure those funds against the property?
Oh, sorry. Like actually, how do we secure our interest in that property? Yeah. So we are not on title. That's actually a really important distinction of our product. Yeah, we are not on title to the property. The homeowners are on mortgage and they're on title. We have a beneficial interest in the property that's secured through a co-ownership agreement that we have with the owners. So that co-ownership agreement is critical. It outlines the rights and obligations of these owners. And we have some other like legal, more like proprietary legal measures that we use to protect our beneficial interest. But at the end of the day, the entirety of that co-ownership relationship is encapsulated in that agreement that we execute with the co-owners.
So it's like a shareholders agreement?
It's more like a joint occupancy agreement, right? Where we agree to be beneficial owners together, but one party gets to reside in the property and therefore they take on these responsibilities around the property. And then the other party, while not an occupant in the property, has these other rights in terms of, how we determine fair market value, if there's a buyout, or if the property is to be sold, etc.
So what happens in a down market like now where somebody can't pay all of a sudden? What happens to the property then?
Yeah, that's a really great question. And in fact, it's one of the main reasons that differentiates us from being a lender. So we're there for both the upside and the downside. If the property increases in value, we share in the appreciation. If the property decreases, then we lose our investment. So that's if we were a lender, our principal investment amount would be guaranteed, right? We would probably register a collateral charge against the property equal to the amount of money that we put forward in the beginning, but that's not how we operate. Because we are an equity partner, we gain only when the property appreciates, and then we are at risk of losing our investment if the property depreciates. So buyers actually find some comfort in a down market by having us as a co-owner, because it diversifies the risk, lack of a better word. They're sharing the risk with us as well too.
What's a typical buyer profile? Like, give us sort of like an example of somebody who would be partnering and using your guys' services.
Yeah, so it's interesting. When we first started doing this, we thought that our demographic would curve younger. That's been one of the most interesting learnings so far. We thought our target demographic would be early to mid 30s, folks, young professionals who are just establishing their careers, who are looking to upgrade from, renting a condo to owning their first property, but they haven't been earning income for long enough to have saved up enough down payment, or they may have been saving, but they just can't keep up with rent payments and whatnot. But what's actually emerging is our audience is older. Actually, it's skewing a lot older than we thought. So it's more like mid to late 30s, young families, people who may have already have children. They've been living they may have moved on from renting a condo to renting a home, but they have children and they're looking to more for that security of having a place to call their own where their children can grow up. So that is like family units are more of what we're leaning towards. A lot of, like spouses with young children. Oftentimes, at least one individual is full-time employed. The other individual may be self-employed or have more like diversified income streams. So that's another kind of trend that's emerging. We also resonate quite strongly amongst newcomer communities, because if you look at the people who don't have access to down payment, these are people who don't have access to generational wealth. They don't
Mom
have
and dad's money.
bank, exactly, that bank, mom and dad, to provide that injection of down payment contribution.
So renters basically.
Of course, yeah. Almost all of our home buyers are currently renters. We do target early home buyers. Not all of our buyers are necessarily first-time home buyers, but they're definitely early in their home buying journey. So we're quite clear on that. We're looking for people who are looking for their first home, not their forever home, because our co-ownership agreement is for a period of 10 years, right? We co-own up until 10 years. They understand they need to sell the property or are able to buy out our share.
So
That's actually interesting. 10 years, right? Because like
That's
just
how
look at
long the agreement is for? It has to be 10 years?
it
Is that what
can
it
be.
is?
It can be. It can be. I'm sure it could
Can
be
be.
shorter if somebody wants
It's
to.
shorter. Yeah, of course.
Yeah.
So you can anytime prior to the 10 years.
So is
They
there
can
a
tell
cap
us-
on this thing? Is it like, can I put in 250,000 and you give me 750,000 and I get a
It's an
mortgage
all
for
cash purchase. Here's
No,
the
no,
here's
no.
the double
No,
check.
he's
No,
buying
not all
in
cash. I'm saying,
Rosedale.
and then we're gonna leverage that. Can we do that?
Yeah, so our down payment, our model caps the total down payment at 20%. Because that's the amount, that's minimum amount needed for properties over $1 million. You actually don't have a choice. You have to have 20%. And
Yeah.
also so that our buyers don't have to pay CMHC insurance, which is for any properties where, total down payment is less than 20. So we do cap it at 20. The reason I say the all cash, because we do have people actually asking
So, but
us,
we
like,
could buy a $5 million house, no?
You have to qualify for that mortgage, though.
you
Fine.
do have to qualify for the
Yeah.
mortgage. We do cap it at 2.5 million. So we do
Okay,
have
that's what I'm asking. Okay, yeah, okay, that makes
Yeah.
sense. Yeah, because
minimum
otherwise
for
it gets
the
crazy.
maximum. Yeah.
But still,
Okay.
2.5 is still amazing.
It's pretty good.
Who
I
out there
guess.
can qualify for that type of mortgage and then, needs this service? But at the end of the day, the option's there. And then
The option is there. Yeah,
Yeah.
we
The option
haven't
is
yet
there.
purchased a $2.5 million home.
yeah, yeah. But in
the
Toronto, that's kind of like, hey, we have to have that card to play.
Yes,
What other
it's-
markets are you guys in?
we are, so the current fund that we're in the process of deploying is strictly focused on the GTA, which is the 7 regions of TREB. I can try and recite them for your viewers or listeners. It's like Durham, Dufferin, Toronto, Peel, Halton, Simcoe, and York.
Nice.
So those are the 7 regions.
Durham's included, Daryl. See? Durham.
Durham has been the story forever.
It's just it's
Straight up the Durham.
affordable, right? So that's
It
that's
is.
It
why
was. So was
On
Peel.
demand.
Wasn't Peel affordable at the beginning? Like the whole.
Mississauga's in Peel. That's not affordable.
Yeah, Mississauga is still pretty up there right now.
Yeah.
Yeah, but Durham definitely a lot of it's Simcoe. People are Innisfil is becoming very popular. Like just
Mhm.
but so that's right now. We are in the process of raising our second fund, which will begin deployment ideally next year. So with Fund 2, we're going to be expanding those regions. We'll be going to Kitchener, Waterloo, Guelph, Hamilton, and London.
Okay,
Neat.
now it makes more sense. That makes a hell of a lot more sense to me. Okay, how can I ask how big Fund 1 was?
I can't share. I don't want to share the exact number, but it's
No
more than
problem.
enough for the deployments and interest that we have. Yeah, and Fund 2 will be a multiple of Fund 1.
So I'm just kind of looking from the investor perspective, and I'm trying to figure out how my money is safe with you. And I didn't hear anything in the security question earlier, so I want to dig a little deeper there. So if I lend you money to lend out, how does that work, and how am I secure? Like I don't feel like I got an answer before. I heard an agreement.
It's a traditional LP fund structure. So
Okay.
our investors are LP unit holders. So that's just, a very common investment vehicle where you park your money. In terms of the securing of our beneficial interests, like I mentioned, we do have like some proprietary legal mechanisms that we use to ensure that properties cannot be sold without our consent. And there can't be additional like charges placed. So a person can't go out and get a second mortgage that would be in a priority sequence over us getting our share and say in a sale. They can't do that without our consent. So we do have some legal mechanism there that pretty much guarantees that, that the buyer is not going to take the property and sell it without us knowing in any way.
And it's a fund, so it's like your guys, ourboro is the one taking the risk in order to manage each and every property and those buyer tenant people.
Yeah.
The fund itself is what is paying out based on obviously your guys' success and returns. I'm sure on a quarterly or annual basis.
Yeah, exactly.
So,
During the harvest period, when people start selling their properties, that's when our investor payout happens. Yeah, so we are almost like there's 2 sides of the company. There's the co-buying side, which we're working directly with home buyers. We have partnerships with mortgage brokers, real estate agents, service providers in that regard. And then there's the investment management side of the company, which is a whole nother vehicle. And I'm happy. I mean, if you have more questions about that, I'd be happy to get my colleague Nick to join you guys in a later session because he could.
We're familiar with different type of structures like multifamily funds, right, Daryl? Like similar, right? You're going to have people who are going to be out there investing their money into the fund, and they're out there buying apartment buildings, and one apartment building might be the racehorse that's, you know, doing really well for the fund, and there's the one that's the dud, and everything in between, right? So you've got, you know,
To
obviously
diversify.
diversification. Yeah.
Yep.
And
Yeah.
make sure that you guys are taking care of things. So that's awesome. What's your background? Like, how did you get into this space?
Great question. I come from a corporate background actually. So my background's in finance and accounting. I started my career on Bay Street working in audit and mergers and acquisitions advisory at KPMG.
Oh
So
yeah.
I
Slow
am that
start, slow start.
classic,
Nothing major.
so vanilla. Oh, I
Yeah.
know, right? And then the joke that I say is I decided at some point I decided to use my powers for good versus evil. Not to say KPMG is evil. It was just the most amazing like, foundational experience.
Don't worry.
Yeah.
No, but truly, like I think there's no other career path where as like a 22-year-old straight out of university, are you like interviewing CEOs and CFOs and really getting into like analytical problem solving.
Mhm.
So that truly is the foundation of my like finance background. And I got recruited from KPMG to work in a number of nonprofit roles, and then kind of caught that social innovation bug while I was working at the Mars Discovery District, which I'm not sure if you're familiar with, but
Cool.
they
Yeah.
are such an incubator for innovation. So I very much got plugged into the impact investment and social innovation community there. Went on to a few different nonprofits, but then decided to move into more of the startups. I do have a master's in environmental science. So at some point along the way, I did a master's degree to really round out my triple bottom line, you know, like the profit, the finance piece, the environment side. And then a lot of the work I've been doing has been on the social side. So yeah, in the for-profit space, worked in Purpose Capital, which was a social impact consulting, like impact investing consulting firm. And that's where I mentioned, like, that's where Norm, the late co-founder of ourboro, and I did a lot of projects together around creative ways to use profit seeking capital to like develop and design business models and projects that could be revenue generating, but sustainable. Um, so yeah, from there, you know, various startup roles. And then eventually when Norm started ourboro, he reached out to me, and it was just an opportunity I couldn't turn down. It was the perfect like amalgamation of everything that we had been dreaming about for so long.
Let's go down sort of like some more social topics then. Like, so affordable housing, like, how do you feel about the current state that we're in Canada as a whole, with the cost of housing and the rising prices of, you know, daily living, and obviously incomes are stagnant. Give us your thoughts on that.
Yeah, for sure. And we get press on that a lot. Like people ask us about our model, like, how are we actually contributing to the affordable housing crisis that's currently in Canada? We can't, there's, if we look at the affordable housing, there's like demand side issues and supply side issues. We can't claim to be alleviating the problem from a supply perspective. We're not involved, at least for now, in building new housing stock. And we do know that where we are able to help is on, at least on the demand side. People who are looking to get into homes just purely are just being priced out of the market. That's the gap we're trying to bridge, because we know that the more people who have access to real estate, that's where true like generational wealth creation has happened. Even if you look at the trajectory of real estate in the past like 50 years in Toronto, it's been, even in like periods of high volatility and market decline, it's been a very steady return for folks who've had access to that investment class. So we're about tackling the problem from the demand perspective. From a overall market perspective, we know that like we look at the immigration numbers, we look at the inflation numbers. Most importantly, we look at the cost of renting in the city, and are comparing that against the cost of owning. As rent right now, it's at this really interesting point in the market where housing prices are starting to plateau and arguably like decrease a little bit in certain markets, but the rental costs are still continuing to rise. So the impetus for buyers to convert from being renters to owner is like stronger than ever, but then interest rates are increasing, right? So there's just
Mm.
all these various forces that are at play here. And I mean, there's a lot, like we have a lot of these conversations with our home buyers around just their unique financial profile, even the types of mortgages they take on. Okay, if you're worried about interest rates, like do you do a fixed, or do you do variable? Like these are all things that our mortgage partners are able to guide our buyers through.
Nice. So as far as the landscape, you're like, you've identified that there's an issue. About solving the issue, you're one amongst many here, which is, how do we solve the issue? We don't know. Like, we're all trying to figure out. The government thinks they've got ideas, half of them don't work. You've got innovative companies like yours who are trying to, inspire people to be able to get into home ownership, because it's almost like just accepting that this is an issue, right? Like, it's kind of like,
It's a very,
how do we
yeah.
solve it?
It's accepting that it is a very pervasive issue. There's never going to be one tool. It's recognizing, at least at a minimum, if we could just bifurcate the problem, there's a supply problem, there's a demand problem. We've at least recognized as a company that we're not solving the supply issue. We're going to at least try and tackle a demand issue by having our our business model where we take capital from investors who would otherwise be landlords. We're at least leveling the playing field there, where home buyers, at least at a theoretical level, are not out there bidding against potential investors, right? So any that, like, at a scaled up version of our model, investors would actually get a better return investing in our fund than being landlords, and definitely less headache. At least, so we're taking investors off the table, at least turning them from competitors to partners in that regard. And then at the end of the day, our social impact is about wealth creation. It's about giving people access to real estate, being able to own in their own terms, in their own way, as a very lucrative form of generational wealth creation.
Does this work in a down market? Who's buying like this in a down market where you can't see that upside anytime soon?
Yeah, that's where, I mean, our investors who've been in real estate for decades, and even our team who's just gone through a lot of the analytics and the numbers, that's where we look at like historical stats, right? And like, I think it's like the 50 years or 60 years, in any 10-year period, even where there's been significant like dips in the market, it is like more than recovered to make up for those dips, where you still have like, I think, average at least like 6% year-over-year return on average. So our investors, they know that it's more or less patient capital. They understand that the investment horizon is longer, and that in itself it creates risk diversification.
That 10-year part of the contract, I think, is unique to you guys.
Is unique to us. And
Yeah.
if you, like I said, I don't want to speak out of term in terms of some of the details around our investment product, but we also look at our deployment periods. We don't take, say, a $10 million fund and deploy it all within a 6-month period. We intentionally deploy it over a broader period of time. To give you, even look at the deployment of our fund one right now, we began deploying it in the beginning of 2021, where markets were at a peak. And then we're still deploying it now when markets have slowed down. So even within the deployment part, like the deployment period, we're acquiring properties at different stages of the market.
So Darryl, one, we got the answer on how big the fund is.
That's
Two, I have an idea for
I noticed
fund number
that too.
3. Ready?
like,
Here it is.
I'll drop some. Yeah, no.
Fund number 3. Don't worry. I know you're just using it as an example.
We're
Fund number
birds.
3. Okay. Daryl's a developer. I'm a realtor. I'll find the perfect site. Daryl will help develop the perfect property. You're going to raise the capital.
You did reach out to us about that. Yeah.
You can. Well, that was another developer that I'm selling the whole building, but this is now be new construction, and then your investors will be able to have this as far as, because really, Darryl, in inclusionary zoning, there's other type of private public relationships and stuff like that. What is missing is a really strong, innovative company who can have a social agenda in order to be able to provide affordable housing. But at the same time, there has to be profits for the investors.
I was going to say, like, it's not
right?
sounding like something I'm so into
Development
until
is
that
there has to be a profit.
there.
Those
Otherwise,
margins
it
are
doesn't
so slim. Like the margins are so slim on these new developments. I mean, that's a whole nother thing. I'm sure you know, but like, yeah.
But the price that you would be selling the units for would be market price. So the margins would be the same as anybody else, but the financing side of it would change. So it would be like a whole building of ourboro finance properties that now people can come in and say, wow, I just need to come up with X amount deposit and meet other criteria, and I'm going to be able to get into home ownership where, developers aren't willing or able to do that typically.
Yeah.
Fund number 3, Darryl.
Well, you know that you got like 75% of the deposits already.
There you go. So for
now
financing,
you're just fine,
and everything
25%.
else.
Boom, we got affordable housing, baby.
And you have cost savings on the sales side. Yeah.
10-year plan. Yep. 10-year plan. Right. So there's lots of little things like that are going to be coming up. And I think that's why I was asking you about like the social housing side, because the government always comes up with their ideas. And so far we haven't heard a good one yet.
Well, so okay. I have an interesting thought. I think it's interesting. Nobody else may. So co-ownership is nothing new, right? And recently there was a launch of a company called Key that has ex-finance minister as one of the partners and the face of it. And when they announced their idea, it seemed sinister and evil to me and maybe it was where it was coming from. I don't know. But when you say it, it doesn't seem so bad. So I'm trying to draw like the lines here between like why this isn't like an evil co-ownership agreement where it's most of them seem to be preying on those poor renters that just want to own and end up getting the short end of the stick at some point in time. So what differentiates this from that? Because I feel like you're genuine and you're nice.
And I've got a great Zoom
And
background.
you
So
have the best Zoom background
everything I
ever,
say.
right? And
Yeah.
forget about the glasses feature at the beginning there. But no, seriously, I mean, I personally, and I know a lot of people feel this way about co-ownership. I mean, a lot of them are scams. I mean, let's be honest. A lot of them are predatory, right? That's the honest to God truth. I'm sure they don't think that they are, but most of them, their contracts are basically like, you know, we're going to end up with your house one way or another at some point, right? So
yeah. Happy. I love that you asked that because I could speak to this like ad nauseum in terms of what differentiates us. So first and foremost, like Key Living, great company. They've gotten a lot of media. They truly are a very innovative solution. They're packaging themselves as a co-ownership, but if you kind of unpack their business model, it's very much more of a rent to own. And that's a really important distinction because you have to look at whether or not the homeowner is on title in the property. So this is what I tell our home buyers when they're looking to compare. First of all, look at who is on title, right? Who has like the most like the gold standard in terms of legal rights to the property as a start. So Key Living, they're a very more I should say like
they're rent to own. You're right. That's a
they
huge
are rent to
distinction. And
own.
that's the predatory part. That's where people get caught. But that just keeps cycling me back or circling me back to how the heck is my money as an investor going to be safe in this thing when I'm not on title? I don't have a mortgage. Like all I have is a piece of paper. What if the guy sells the house?
Right. Well, so that's what I think as you know, a participant in this space, I'm very reticent to label any other company as like predatory. I think it is really about
No, I'll do
transparency
it. I'll do it though.
and how they package their product. So a lot of rent to own models, buyers, or I should say renters, are coming in with a very marginal stake in that property. The good side is like the barrier to entry is very low. Like you could be living in a condo and starting to build equity for as little as like $5,000 worth of savings. So they are getting quote unquote into the market and getting a little bit of that equity upside. But at the end of the day, the economics of it is really not all too different from renting in terms of what they contribute to the property, etc. But they are able to build up equity over time. I don't think they ever get to a part where their equity interest is significant. With ourboro, our homeowners are on title on day one. They have at minimum 25% equity stake in that property.
So how much do they own? We never talked about that. That's important. How much do they own if they
minimum
put in
25%? So
Yeah,
if they got a
minimum
20%
25%.
down payment, then they've put like on $1 million property, then they've put down $50,000 at least.
At
Right?
least,
There's
exactly.
200,000 equity, and so they got $50,000 of it, but they can put more.
So, but if they put down
Exactly.
25%, they own 25%. This is how it works.
Yeah,
I see.
exactly.
Okay.
If they put in half of the down payment, then they have 50%. And it's
Got
not,
it. Okay.
we're not saying we own 50% of the property. We're just saying we have a right to 50% of the profit, the appreciation of value. That's a clear distinction because a lot of people are
That's
like,
a
wait,
big distinction.
yeah, they're like, wait, you're
So it's
putting
like a
in,
personal loan then.
it's a little bit, but there's no collateral, there's no interest. It is pure, you are trading in the future equity for today's down payment.
Wow.
And that's what people need to understand. So much about these innovations in housing or innovations in home ownership requires homeowners to have a level of like financial literacy, for lack of a better word. So we invest a ton of resources in terms of onboarding our buyers. I'm not personally familiar with the Key Living like intake process, but for our team, anybody who applies, they're on like a 20-minute discovery call, the one-on-one with a live agent. They sit through a 60-minute onboarding where it's just them and their partner or their household with an ourboro co-buying specialist. We walk them through the rights and obligations of the co-ownership agreement. What happens if markets go up? What happens when markets go down? Like what happens if you want to buy us out? We really invest in making them understand our model. So they're going in with eyes wide open. We actually even make it mandatory that they get independent legal advice on our co-ownership agreement, even after we've walked them through everything. So buyer acceptance and transparency is like so core to our model right now.
So when we tried to contact, well, not we, I tried to contact Key and get a copy of their agreement, and they wouldn't give it to me.
I wouldn't give you a copy of ours either. That's our proprietary IP. Like,
Is the agreement the proprietary IP of the whole thing? Wow.
it's as close to it as possible.
The structure for the investor, absolutely. They want to know how their interests are being protected. And at the same time, the tenant wants to know why this, is going to benefit them. And, absolutely. I agree that's very proprietary. Okay. So here's the big debate. And this
Sure.
it's age old. Is it better to rent or to
Yeah.
buy?
You should take her quiz. This is the plug. We just published a quiz. Like, what type of home buyer are you? Like, emotional or financial, right? And that's kind of, we talk about, like, if you're renting, because it's an age-old question. The reason why it's such a, like, pernicious debate, pernicious in the sense that it just takes various forms. Like, people have to get very heated. It gets very negative. It's because there's so many variables. Just an example, as a renter, how much are you saving, right? Relative to home owning. Some models that I've seen when they compare rent to own, they're assuming that 40% of your disposable income is going towards saving, and you're putting that into, like, S&P 500.
Nope.
Right?
It's funny. Yeah. The same
not anybody
people,
that I know. Right?
and the same people that make
know.
the reports that say that, people only have $500 in their bank account at the end of any given month are the same people that are assuming that people are putting away 40%.
Right, exactly. So by those assumptions, then renting is absolutely better. If you have $150,000 that you could put towards a down payment or put in the S&P 500 and then or whatever over time, sure, right?
Yeah.
If you're purely looking at it from a financial
you can beat the market with that level of discipline. Absolutely.
Right. But that's also if you're very, like, financially focused. You do not place any weight on the stability of having a place to call your own, a home that you could, like, you don't need permission.
And you live in a $900 a month apartment where, you don't turn on the furnace until like December. Yeah.
Yes.
So lifestyle too changes are important.
Lifestyle, saving rates, income, just the emotional aspect of what it means to be a homeowner, like family, proximity to schools, neighborhood, all of these things. Like, you can't get, if you have young children and you want to be in a nice neighborhood close to school, you can't find rental units in some of these neighborhoods, right? Like, it's just the practicalities of where home ownership fits in your lifestyle. These are very, very personal factors. So that's why there is no definitive answer. But if you take her quiz, you can maybe, like, better understand where you fit along that spectrum.
Nice.
Click the link below to take the quiz.
Yeah, we'll put a link in the description. So, but this is exactly what I guess I'm trying to get to is, like, yes, there are people who will be able to save that down payment. They've got help from mom and dad. They're in a position, maybe they're in a town or a city in Canada where it's a lower bar of entry, so it's a lot easier for them to get in. But in the GTA, which is where your company's operating, there's a lot of people who just don't have the financial literacy to be able to, one, save, or two, rent their whole life and build that wealth.
Exactly.
And then if they don't get into the market when they are going to be retirement age, there's a significant difference in their lifestyle security, and they end up they're suffering because they weren't able to get that initial head start, like maybe some of us had through our families and different, socioeconomic environments, or going to get the financial literacy along the line from somebody who's, willing to help. Right. So there is a need for it.
Yeah, you nailed it. That's our ethos. It's about, we want people to not use ourboro after they use ourboro. So we are the stepping stone for them to get into the market. Like I said, they have significant equity stake in the property from our model. And then when they sell the property with ourboro, they're going to cash out on their equity share. And hopefully for that next home they purchase, they'll be able to do it 100% on their own. Right. So that very much is an intention that we have.
Because I'm a realtor, anything that I say is only because I'm trying to earn a commission and I don't care. But I'm just aware. I understand. I've met a lot of people, and I know that, yes, there's a few people who can rent their whole life and be very successful. But the majority of people that I meet just don't fall into that category. They need to be in a forced savings environment where they're paying down the principal on their mortgage. They're having appreciation on an asset that's not liquid.
That's just the old programming. If people were taught a new way of doing things,
I agree.
Start a Shopify
where will they learn this, Darryl?
Right here, baby.
Right here, Canadian Real Estate Show. All right, subscribe. Let's go.
So I can't. Okay, so down market, I'm sorry, I can't get my head around this from an investment standpoint, unless I'm just a super nice guy, which everyone knows is true. But
The fund's
Diversification.
not the issue, Daryl. They got
no,
two
but
funds. They got the
no,
fund's
but
not the issue.
I get it. I'm trying to
Yeah.
understand it. So what happens when we've backed this person, we have the rights to 75% of the profits one day, and the house goes down in value, and they can't hold on. They want to sell the property at a loss to get the mortgage off, or to get the bills paid, and to stop, you know,
Yep.
the heart palpitations. So what happens to you guys? You just walking away from that money, and you're hoping that the next bet like covers?
Pretty much. We will never get in the way of a home buyer wanting to sell their property. That's like a very core principle of our ownership agreement. If you legitimately want to leave your property and you're willing to, like, you're selling it to a third party, we will, and you're selling it at fair market value, we will never say no to a legitimate sale. And so if it so happens the market is down, because this is where it's one of the things that personally I take a great deal of pride in our co-ownership agreement, is it's crafted to be very much interest aligned between our investors and our homeowners. A lot of the fine print is really just to like merge the alignment of incentives between homeowners and investors. So in a scenario where the market is down and the homeowner needs to sell, we know that the homeowner does not want to be losing money either, right? It is in their best interest to sell for as high of a price as possible. And in the event that they absolutely have to sell at a loss, it's going to be for a pretty damn good reason. And if that's the case, we never want to be the company to get in the way of that. And so we say, even if it's at a loss, we take that loss and we move on. That's what we have from our investors' perspective. That's the benefit of having a diversified portfolio, different geographic regions, different built forms, and even different like demographics, arguably too. So from unfortunately for that home buyer, they are at a loss, right? But that is the risk that any home buyer takes when they buy a home. And arguably that home buyer who's sold in a loss environment and having co-owned with ourboro is actually less worse off than a home buyer who owned the home on their own, who put up, the entirety of their down payment on their own, and didn't have a co-investor. They'd actually
Or if they had just rented for those 4 or 5 years.
Why? If
Right.
they lost money, they're worse off than
But what about the cost of rent during that time?
They
Right?
didn't
At least
lose
they've
any
paid off some
money.
principal, but no, they lost all that rent. 100% of their monthly payments are gone. At least they're going to be paying off some principal.
Yeah, but they
Right?
have the money that was in the stock market, and now they
Exactly
bought
performing
bit,
at 20%
right?
ROI. Yeah.
They're okay if they're
I'm
smart.
sure that scenario exists somewhere
yeah.
in, the North Pole. But also you have
No, hold on a
like
sec.
qualifying. What?
Okay,
Go
well,
ahead. Go ahead.
I
We'll
was
unwrap
just going
it.
to say, well, this makes a lot of sense in like Saskatchewan, or like in New Brunswick, or where the prices are not like $1 million on average, where the prices are 2, 3, 400,000, and there's not that much risk. I can't seem to get my head around, when the market's going down, why anybody in the world would invest in the fund, knowing that a bunch of their money is going to probably disappear now, waiting.
It's actually, it's the opposite. If
Yeah,
markets are low, it's a
what am I
good
missing
time.
here?
It's a good time to buy, if knowing, because we believe in the long-term appreciation of real estate, which has been very, very reliable.
You need to
So if
spend
markets,
time in our comment section, because maybe I'm getting jaded, because I feel like the whole world is falling apart and the end of the market is coming, and we got another 40% leg down.
well, let me ask you, what's worse, buying at the peak of the market or buying at the low? You want to buy low.
Yeah, but what if you're in the middle and it's still going down? That's where we are right now, aren't we?
But even
TK,
with
where are we?
that,
Are we there? Are we on the way down still?
We're on the way down still, of course, but like I said, no, and we said this before you jumped on the call, Alex. So far, no one's been able to predict the future, and you guys are not just looking at this as a gamble. You guys have been looking at immigration numbers. You guys are looking at housing supply, construction starts. You know from experience, and the people who are in your fund are accredited investors. The reason they're accredited, Darryl, is because they have enough wealth to become an accredited investor, which means. This is something our last guest said, so I'm going to steal it from him. 95% of the world's wealth is in the hands of 5% of the population. So if you want to know what to do, go and ask all your friends who don't have any money, and whatever they say, do the exact opposite. So right now, Warren Buffett, right? buy fear, sell greed. Right now, there's a
I'm
lot of
not
fear.
disagreeing with
Yeah,
buying a
I'm not
house.
saying I know, but I'm saying
I
this
think
is
it's a
what their
great time to
mentality is.
buy. Yeah, no,
Yeah.
I don't think it's a bad time to buy a house. I just don't understand investing into this model into a down market. I'm sure there's a great reason and I'm just missing it.
The people they're getting too, like you guys aren't to qualify underneath your terms, which I don't know them all, but I'm just putting that buyer profile in my head. These people have got good credit. They've got secure
They
jobs.
must be
They've got high
immaculate.
income. They're
Yeah.
just not able with the financial literacy side to save enough money for a down payment and to structure their life accordingly. It's a service for those type of
They
people.
must be
It's not
spick and span. Like,
it's not low income people that
clear,
are not doing well.
we do have a lot of like we have like people with finance backgrounds where it's I wouldn't say it's lack of financial literacy. It's oftentimes it truly is they're being compared to people who have access to that bank of mom and dad. And even if
That
you
too.
are a
Right.
very diligent saver, what is the recent national bank I think came out with stats around it takes 32 years for the average individual to save for a non-condo in Toronto. I think their estimates is a 10% saving rate and an annual income of about 88,000. Like
yeah, and it's all bullshit. Yeah.
32
It's
years.
worse.
And the reason why
Exactly,
like
yeah.
anybody buys sooner than that is because they get like $100,000 checks from the bank of mom and dad. And so for those who don't have that, they're not inferior because they don't know how to save. It's because they're being compared against people
True,
who
you're
have
right. I made an assumption there, and that's actually what it is. There's a disadvantage being in the GTA because of that factor. You cannot save as much as the prices have gone up over the last, adult life that these people have 10, 20 years, whatever it is. They haven't been able to keep up.
Yeah.
How does was that satisfy you, Darryl?
No, nothing satisfies me.
Okay.
But no, I listen, I'm serious. I think it's a wonderful model. And especially from the buyer's standpoint, it sounds like amazing, right? But when I put on my investor hat, it's like, what happens if this thing goes sideways? I mean, it's always about risk and limiting your risk when you're putting money into something. Right. So when the only possibility for profit is increase in the market and the market is decreasing, there has to be another.
They're paying down the principal as well.
Yeah, but you might not own it by the time it comes up again.
But every payment they make, the principal is going down, and you've got a percentage ownership in that equity. So it's not just appreciation.
We don't our share
It's
is
nothing though. It's a tiny bit.
Only on the
principal
appreciation.
repayment go back to the homeowner.
All right,
So the
I take that
homeowner
back.
gets the principal back. The homeowner get more out of that than just when the property is sold, they get more than just their like 25% of the profit. They get cash perspective, they get the share of the profit, but also whatever they pay towards principal.
Very reasonable. But Darryl, here another counter argument is
give me another wrong counter argument, please.
No, that's okay. That was a good. I thought that sounded good.
It sounded great.
Multifamily, right? Those are renters who are paying rent. They have no interest in the property. If they don't pay, you as an investor are on the hook as a limited partner in that same fund. They have no interest in the property.
And where's your payment in relationship to renting?
They have no interest in the property. The person who's going to be an ourboro client has interest in the property. They want to pay. This is all for their benefit. They're not making the investors rich. They're trying to help themselves grow. So if you were to look at risk,
if the market turns in a year, it's great if it turns in a year and a half. But what if people are right and this thing doesn't come back to today's levels for 10, 12 years like it did in the 80s?
There's a 10-year agreement for that purpose.
Well, but that's not 12 years.
That's the gamble.
That's the gamble.
The risk is that we are
long term.
The market to turn within 10 years. That's really truly what it comes down to.
That's what it comes down to.
We're confident, based on 2008, 2017, we're confident in market's recovery ability.
And I would say that that's a good gamble actually, but that's the crux of it is it's the 10-year play and we're willing to let a couple of hands kind of lose if we have to, but we're going to be in at all different levels. And at the end of the day, we're going to make a very nice blend.
And as a renter,
and provide a wonderful service to people in the process.
That's 10 years of like living in a home of like memories being created in a place to call your own. Like that has intrinsic value.
And how much does the tenant in that apartment building get at the end of 10 years? What does the landlord refund them at the end of 10 years? Right? So it's a good service. I mean, you guys are all coming from this social innovative background and everything else. And this is definitely very clearly even, and Darryl, all your points are very valid. I know that, but it's very clearly heavily weighted in the favor of the, tenant buyer here, the person who's buying the property and the client of Arbro,
which is amazing.
All the descriptions, I never like the label. I'm not, I always forget what it is. What do you call someone? You just call them a buyer?
You call them the occupying owner. Legally, they're the occupying owner.
Occupying owner. This is clearly heavily weighted in the favor of the occupying owner. Like you really are.
Yeah, we got our hands on that key contract finally, and they called them suckers. Yeah, it was pretty interesting.
That's not true.
That's not true. Remove myself from this conversation.
That's not true.
That wasn't true.
Okay.
Just for legal purposes, right?
So
TK's sweating today.
We're at the end. We're at the end of the show anyway. So we got a few more minutes here. So I want to kind of just like get people like, how do they start? How do they contact Arbro if they're listening to this call and they want to be able to reach out to get more information? What do they do?
Yeah, it's ourboro.com, ourboro. I was like reading the title, but it's backwards on my Zoom background. Did you realize that? It threw me off.
Ourboro. No, it says
Arboro for me.
Not that I don't know how to spell our name, but it was just like I glanced at it and it threw me off. But it's ourboro.com, and then there's a get started button everywhere. That's where you get it's like a 7-minute application. You provide some basic information about your profile, like where you're looking to buy, etc. And then you'll be invited immediately to schedule a call with one of our co-buying specialists, in which case we go through your application in more detail. And then the next step will be referring you to one of our lending partners to get a mortgage pre-approval.
Wow.
And go from there. Yeah.
And I like how you're not a real estate agent background, because not to say anything bad
so
about real estate agents. There's lots of smart people in real estate.
Not to say anything bad about anybody on this show, right?
Nobody does that.
Well, I'm just trying to keep it consistent, but you're definitely super smart. You're super smart. You got a great background in finance. You understand things. And I think that, it's credible. And I think that somebody getting advice from you, it doesn't seem like, commission motivated. It seems like, hey, how can we help you get into home ownership? And I generally get that feeling from you today.
Yeah. So. And then I think I would have to say that extends to everybody on the team as well, too. Everybody comes here with a very, very strong social lens and impact oriented minds in terms of approaching their work. Our relationship team, our investment team, there's that the ethos is deeply embedded in everybody in the company.
So and what happened just quickly between because you went back to what, 2008? Is that what you said? The inception, 2006? What was it?
No. Well, I mean,
I know you
incorporated in 2019. Yeah.
But what was the initial idea you mentioned was like?
It's the journey of just how do we creatively use profit-seeking capital to bridge these wealth divides. That thesis, that challenge statement has existed in the work of myself and our co-founders for over a decade.
Nice.
Interesting. Amazing. Cool. Well, thank you.
Good timing.
Yeah.
Well,
that's got to be part of it, right? Like at some point, the timing, something shifted for this to be a viable idea, right?
Yep, exactly.
I don't think it was the technology.
It's needed now more than ever. Like whether the market's going up or down, we're still in an inaffordability crisis.
Mm-hmm. Yeah,
that's for sure.
I mean, there's similar models in the US, so there's definitely inspiration from similar models in the US, but we're definitely the first in Canada to be doing this.
Mm-hmm. Cool. And it's unique. I don't know anybody else doing this at all, so that's great.
It sounds amazing.
Anything else, Darryl? Any other questions?
I have all kinds of questions, but we're out of time, so maybe we'll have to have you back again if you're willing.
Yeah, that'd be wonderful.
Absolutely. We really appreciate it, Alex.
We had a good time.
And, if people are still listening right now, which generally speaking they are, they can comment, and subscribe, and go check out Arboro on their website.
Great, and I'll send you a link to our quiz.
Awesome. Yes, and the quiz. Awesome. Thank you so much, everybody.
All right.
Have a good day.
Bye.